Hey everybody, it's Jack and welcome back to another portfolio update video. It's been a little bit of a shaky past couple of weeks in the stock market. We've seen quite a bit of a dip over the past 2 to 3 weeks in the stock market, both in Canada and the US. So today's video, I'll be going over what I've been doing, what I've been buying over the past couple of weeks, how my portfolio is doing, and also where I'm looking to find value in the stock market moving forward. To start off, last week the S&P 500 dropped over 5% in the single week, and the Canadian stock market dropped around 3.5%. So we've been seeing a lot of volatility in the stock market over the past few weeks, and I really think this is one of the main factors is inflation. We've seen inflation rates really start to rise and are sitting at almost all-time high records. In Canada, inflation is currently sitting at around 5%. Whereas in the US, it's actually a little bit higher at almost 7%. And inflation has always kind of been seen as this big bad wolf to the stock market because historically, as inflation rates rise, we see lower returns in the stock market because interest rates are rising and companies can't really leverage any debt. And a lot of companies in the stock market leverage debt in order to grow their businesses, especially smaller companies that are still really early on in the stages of their businesses, and companies as a whole, they usually leverage a lot of debt and kind of are higher risk because of that. So before we dive into showing how my portfolio has been doing and going over the stocks that I've been buying over the past few weeks, let's quickly touch on my strategy as a whole. So because of the current state of the stock market, I obviously have not stopped buying stocks. I like to dollar cost average and continue to buy on a regular basis. However, where I've been allocating and putting my money has kind of shifted a little bit. I'm starting to slow down on adding to those smaller cap, kind of higher risk stocks, as a lot of the stocks do leverage debt. And if interest rates do begin to rise, we will see a harder time for those smaller companies to pay off their debts and pay back higher interest to the companies that they lend from. So that's one thing that can really kind of halt growth in those smaller cap companies. And then on the flip side, where I've been actually spending my money and buying into stocks are stocks that are in the consumer staples sectors, as well as kind of in the resources and commodities. These are parts of the markets that in times historically of higher inflation have outperformed their counterparts and other stocks in the market. So for this reason, I'm really starting to shift to adding some more positions in my account that are in the consumer staples sector, as well as boosting up some of the positions I have in kind of resources, whether that be precious metals, electricity, oil and gas. All those utilities companies in times of higher inflation, they also kind of outperform. So without further ado, let's jump into how my portfolio has been doing over the past month or so. So my portfolio currently sits at $16,087.47, up around $527 all time. So you can see that this has taken quite a bit of a hit since my previous update video, where I think I was hovering around $900 to $1,000 in gains, and now we're down to all the way to $527. So quite a substantial drop over the past month in terms of the stock market, and I'm curious to see how your portfolios have been performing as well. Let us know down below in the comments how much of a hit you've taken, or even if you've taken a hit, maybe you've outperformed and actually done well over the past month. And this $16,000 is broken into two different accounts. My main account, which is my personal account, which sits just north of $15,000, and it's up around 3% all time. And then we have my RRSP, which is where I hold my shares in Pepsi to take advantage of the zero withholding tax in an RRSP. And that account is sitting just south of $700 US. So that's in USD. If you convert that to Canadian, it's roughly around $1,000 Canadian. So that's kind of where it makes up the 16,000. And as you might have noticed, I do have US dollar accounts here on WealthSimple Trade. I was lucky enough to get early access, and I'll be making a video that will come out shortly in the next few days that will go over their US dollar accounts, how the features kind of work, are there hidden fees, where are the fees? So definitely stay tuned for that video where I dive deep into the US dollar accounts and whether they're worth it for you. And if we just quickly take a glance at how my portfolio actually did last week specifically, we can see that my portfolio was down $391 or 2.5% last week alone. So the entire Canadian stock market dropped around 3.5%, the TSX index, and my portfolio dropped 2.5%. So I guess you could say we might have slightly outperformed the market last week. But again, we have seen a couple negative weeks in a row, so it has really hindered the performance of the portfolio. We were up almost $1,000 or even more than $1,000 at one point, and we're now back down to just $500. Let's now dive into my portfolio spreadsheet where I actually go over the exact stocks that I've been buying over the past few weeks. So now that we're inside my spreadsheet where I track all of my stock positions as well as my dividend and passive income from those positions, let's start off by taking a look at the stocks that I've been buying over the past few weeks. Starting it off at the top with Algonquin Power and Utilities. This is a stock that I've been buying for a while now. It's been not performing very well. As you can see, I'm currently down over 9% on the position, which is a dollar loss of over $100, and it currently makes up 6.8% of my portfolio. Algonquin Power and Utilities is a utility stock that has 33% of its business in renewables, and renewables as a whole have not been doing well over the past few months. However, long term, I really like Algonquin Power and Utilities as a Canadian dividend stock. It currently has a dividend yield just under 5%, so a really solid dividend, and it has grown its dividend at around 10% on an annual basis. So by holding this one long term, you get that annual dividend growth. So because of this, I've continued to dollar cost average into my position by buying 1 or 2 shares here and there every kind of week or other week. The second main dividend stock that I've been adding over the past month has been Brookfield Renewables, ticker symbol BEPC. And this is yet again another kind of renewable based utility stock. I'm currently down quite substantially on this position, over 18%, which in dollar amount is almost $200. This is one of my biggest losses to date in any position. And Brookfield Renewables currently makes up 5.4% of my portfolio. What I really like about Brookfield Renewables, again, it gives you that long-term vision in the renewable sector, which I think I'm very bullish on moving forward, looking at, a decade, 2 decades into the future. We're definitely gonna have to be moving towards more renewable options in order to help save the planet. And at the current price point, Brookfield Renewables actually offers an almost 4% dividend yield, which in my eyes is just a really great dividend yield. So I've also been buying around 1 or 2 shares of Brookfield Renewables on a weekly basis. And if it stays at the current price point, around $40 to $42 per share, I definitely will continue to buy this and really dollar cost average lower into this position. So taking a look at a third dividend stock that I've been adding over the past month, it's one of my newer positions in Agnico Eagle Mines. This is a gold mining stock. And as I mentioned in the onset of this video, I think that commodities or resource-based stocks are going to do really well in this inflation period. So a good way to hedge against this is by picking up some commodities or resource stocks. And Agnico Eagle and gold in general has really been known to lead the way in terms of a hedge against inflation. So I've been picking up a few more shares of AEM. I now have 9 shares total. I'm currently slightly down on this position, about break even, and it currently makes up 3.6% of my portfolio. So I'm probably going to keep this one under 4%. 4% would be the highest I go. But anyways, moving on to my latest and newest position in my portfolio is actually ticker symbol ATD, which is Alimentation Couche-Tard. This is a consumer staples. I have it labeled as a growth stock because it does have a dividend. It's under 1% though. It's sitting around 0.8%. So it's a much smaller dividend compared to my other dividend stocks. So I've labeled this as a growth stock because the primary reason I'm holding it is for appreciation in the share price and not really that dividend. The dividend really is just a bonus to me. And ATD is really a global brand, which I also like. They're in Europe, Canada, the US, you name it. They own all the Max Milk, the Circle K's, as well as a lot of the gas stations. So because of this, I really like it as also kind of a hedge against inflation. They also just have a great track record for growth, and I think they're going to be able to continue this moving forward. So I have started a really small position in Alimentation Couche-Tard. I only have 3 shares to date, as it makes up under 1% at 0.9% of my portfolio. I've just been buying 1 share a week over the past 3 weeks, just dollar cost averaging into this brand new position and building it up. I'll probably build this one up to a 2 to 3% position, so not huge. But again, just giving some additional weighting to the consumer staples, which I see as being a good hedge against inflation moving forward. And in terms of my other growth stocks that I've been adding to over the past few weeks, I've also been adding to Green Lane Renewables. This is a renewable natural gas company that has not been performing well at all since I've owned it over the past few months. I'm currently down almost 30% on this position, and it's my largest loss to date. It makes up 3.1% of my portfolio. I currently have 450 shares of GRN. However, again, I'm super bullish on this stock going forward. They've been growing like crazy, and they have a backlog of work to do that's over $50 million in orders. So because of this, I think they're just going to continue to grow as we move towards more renewable options into the future. So this is another one that I've been dollar cost averaging over the past few weeks. I usually pick up 15 to 25 shares each week, and I'll definitely continue to do so at this current price point. I've also been adding a few shares of DCM, Data Communications Management Corp, each and every week. This is a marketing workflow and management company. I made a full video on the stock breaking down why I'm buying it, so I'll link that on screen. But I also see a lot of upside in DCM, so I've been buying around 10 to 25 shares of DCM each week as well, and it currently makes up 2.5% of my portfolio. So now going into my ETF positions, I currently hold 4 ETFs, And this is actually where I've been adding the bulk of my money over the past month. I've been really trying to ramp up my positions in my NASDAQ 100 ETF, QQC.F, as well as my S&P 500 ETF, VFV. Both of these I want to have around 10 to 15% at a baseline minimum in my portfolio to give my overall portfolio 20 to 30% weighting in the US stock market. Just because if you look at the global economy, the US makes up a huge chunk of it. So I want to make sure I take advantage of this and get some exposure to the US markets. So because of this, I've been buying a share of QQC or VFV every single week. So I currently have 11 shares of QQC. It makes up 8.3% of my portfolio. I am currently down on the position because of the big hit it's taken over the past 2 weeks. But again, I see this as a buying opportunity as I continue to grow this position even more. And the same goes with the VFV. I currently have 16 shares. It makes up 9.9% of my portfolio. So this is actually the largest position in my portfolio. But again, it's a no-brainer. The S&P 500 on average sees around a yearly gain of 8 to 10%. So it's a great one to just hold long-term as a baseline in the portfolio. And then I've also been adding to my Canadian tech ETF, XIT. This is one that's been getting hit extremely hard over the past 2 months. At one point, this position was up, I think, 20% for me. It's now down almost 15%. So a huge swing over the past few months because really the main tech companies in Canada, like Shopify, have been getting hit really hard. So that directly plays into XIT. However, again, I've just been dollar cost averaging and taking advantage of this major swing to be able to lower my average cost on this position, just by buying a share here and there. So that's it for all the stocks I've been buying over the past few weeks. Let's now dive into my actual dividend tracking. So currently my portfolio is generating an annual dividends of $466.84. So just by holding the stocks that I do, every single year I'm generating almost $500. Hopefully we'll hit that $500 mark soon. And if you can actually look at my previous video that I did, so it says previous week, but this was actually around a month and a half ago. In my previous portfolio update, it was sitting at $399. So I've generated almost an additional $70 in dividend income every single year for the rest of my life by adding dividend stocks over the past month and a half to my portfolio. And my monthly average is now just under $40 at $38.90. So again, just to stress, this is money that I'll be getting every single month on a monthly basis on average for the rest of my life, which is really crazy if you think about it. And again, that snowball is just going to continue to grow as those dividends come in and buy more shares on top of me continuously buying shares. And if we look at this chart I've set up to actually track this, we can see from the back when I started this challenge, we were getting, 50 cents every single month, $1 here and there. And now we've started to grow that by just continuously buying dividend stocks and our ETFs. It's now become quite a substantial amount of money. This chart just shows that on a monthly basis. By staying at it, it just grows and grows and grows. And it's going to start to grow exponentially and really start to allow us to almost live off of our dividends. That's kind of the end goal one day, being able to just retire and live off of this monthly dividend income. Taking a look at our portfolio breakdown chart where we can actually see how much each position has in weightings against each other, we can see that my largest positions are my two ETFs in VFV and QQC.F, both being 8 to 10%. And then the rest of my positions for the majority fall kind of in that almost 7 to 5% range, 7 to 4%, so that I'm well diversified both in stocks and sectors and not overexposed in certain areas. So taking a look at the actual sector allocation, so adding different stocks up by sectors and seeing how much each sector weighs, we can see that my ETFs, again, are my largest positions. Then we have financials at 13%, so TD and Manulife, my utilities at 12.4%, renewables at 10, and then it kind of goes down to 6 and 5%. But I really like this chart just to kind of see what kind of sectors you might want to boost up in your portfolio, or some sectors you might want to stop adding to bring them down. And my final chart that I have is my asset allocation. So this shows my breakdown between dividend stocks, growth stocks, and ETFs. So as you can see, dividend stocks make up the majority of my portfolio. They're definitely my favorite type of stock, and they make up 61%. And then my growth stocks make up 10% of my portfolio, as these are definitely more higher risk investments, and they have not been performing very well for me over the past little while. So I definitely am not adding aggressively to these ones. I'm letting them play out and slowly chipping away at lowering my average cost. And then my ETFs, as I mentioned, I'm really trying to bring up in weighting to get more exposure to the US markets. And this shows because this portion of the pie used to be around 20%, and you can now see that it's almost 29%. So it's grown quite dramatically as I've increased those positions in my NASDAQ 100 as well as my S&P 500 ETF. So now taking a look at my weekly watch list for the week ahead, what stocks am I planning to add to? Well, I'm first continuing to grow my Alimentation Couche-Tard position, ATD, and I'm just going to continue to do what I've been doing over the past 3 weeks, which is buying one share every single week to slowly bring up the position and kind of get it to that 2 to 3% weighting. And then the second growth-based ETF or stock that I'll be buying is QQC.F. This is the NASDAQ 100 ETF. And as I showed, my VFV position, my S&P 500 is sitting around 10%. And I want to get this NASDAQ 100 to that same kind of 10%. It's currently sitting around 8%. So hopefully by adding one more, especially on the drop that it's been seeing because of tech selling off and things like that, hopefully adding one more share will get me to that 10% range. And for dividend stocks, I'm planning to pick up one more share of Smart Centers. This is a real estate investment trust that pays a monthly dividend. So I just like to add to this position to really just have some stable income on a monthly basis in terms of dividends. And this is a great one that I think will also see some growth in its share price and also pays around a 6% dividend. And again, it pays you monthly. And then the final stock I'll be adding to over the next week is Brookfield Renewables. This is BEPC. This is a stock that is down almost 20% for me. It's definitely one of my worst performers to date, but I still have a high conviction in it and the renewable sector in general. And I really like BEPC moving forward. At the current price, it has almost a 4% dividend. So I'll be looking to add one more share of Brookfield Renewables over the coming week to, again, dollar cost average and get that 4% dividend. So there you have it. I think the main thing to recap is the fact that we are going to see these types of weeks in the stock market where they can drop as much as 5% as a whole. And the main thing to keep in mind is really just to continue to stay consistent, know your strategy, and continue to buy your favorite stocks. You should be happy to see them drop because then you get to buy them at an even better evaluation, which over the long term, buying these dips really pays off. And even though it might seem like quite a substantial drop, 5% in a given week, or maybe some of your stocks are even getting hit more, if you just take a second to zoom out at the overall stock market over the past 10 years, you look at that 10-year time frame, you're really going to see that those little drops that we're seeing over the past few weeks, when you zoom out, really don't equate to a whole lot in the big picture, and that it would be silly to stop investing in these times. It's actually to your advantage to continue to dollar cost average, and that's really been my strategy over the past few weeks to a month and going forward. I'm focusing on the kind of commodity and consumer staple stocks, so adding new positions such as Agnico Eagle and Alimentation Couche-Tard to my portfolio in order to boost those kind of sectors up a bit, because historically in times of higher inflation, these sectors of the market have outperformed the others. So that kind of reason I'm kind of hedging against inflation by adding to some of these positions and boosting up some of the positions I already have that are down substantially, such as some utility stocks like Algonquin Power, as well as Brookfield Renewables. Two that I believe in long term are going to be great buys. But again, I hope you guys enjoyed this video. If you did, smash that like button and make sure to subscribe to the channel. Lots more videos coming your way. I'll see ya in the next one.